Hi guys, I hope you're all doing well. So you must have noticed that the stock market's been pretty volatile lately.
No!
It dipped on day one and got us all excited because we know that when the market dips, it is time to buy. But then on day two it dipped again, and on day three it dipped a little bit more, and suddenly it became pretty hard to hold on to that excitement. I totally get it, and I know how you feel. I literally stopped looking at the app after a while and turned off all those price notifications because it was kind of messing with my head. Anyway, emotions aside, let me take this opportunity to explain to you in plain English why the stock market is behaving the way it is and whether it has anything for you to worry about. Firstly, let me make it very clear that the whole stock market dipping situation initiated from the US stock market. As you may have heard from the news that the US government has been giving away an unprecedented level of stimulus into the economy to their people to help them cope with the COVID-19 situation. This is not limited to just the direct checks. It includes a lot of resources for smaller businesses, preserving jobs within vulnerable industries, emergency rental program for those who are unable to pay rent, and many more. Now, if you think about it, the government needs to somehow have this money already before they can pay them out. So how have they done that? One of the most common ways for the US government to get this money is by borrowing them from individuals, corporations, and other governments all around the world. And they have been raising this money by supplying US government bond in the market. And anyone can buy these bonds, which are called treasuries. If you are buying this, you're ultimately lending your money to the US government. Now, take a guess as to who is buying most of these bonds. Yep, the US central bank, called the Fed. Central banks are independent entity from the government, and one of the key roles of central banks of any country is to keep the country's inflation rate at check. This is set at 2% per year for US. Since COVID meant everyone stopped spending, we were getting downward pressure on this inflation rate. Recall that inflation is the general changes in prices of goods and services that we pay for. This was, of course, a great deal of worry for the Fed in the US. So, the key policy tool that the Fed uses to control this level of inflation is the base interest rate. Since inflation was dipping, central banks were cutting interest rates in the economy. Low interest rates meant people can borrow more cheaply and have less debt payments overall. Now, the good news is this low level of interest rates, they're not only just beneficial to consumers like me and you, they're also helping the US government to service their own debt. The US government took on tons of debt in order to stimulate the economy, and this has pushed US's debt to GDP ratio from just over 100% to 136% over Q2 2020. In plain English, the US now has more money borrowed than what their economy is actually worth. Anyway, those stimulus from the US government have actually started to work. Well, let's just say that they have actually started to work too well than anticipated, because now the inflation rate in the US have slowly started to tick up. Although the actual inflation rate hasn't yet reached its optimal level at 2%, the financial market has already started to price in or predict the level to go above 2% in no time. One such measure of predicted level of inflation rate is called the break-even inflation. We get this figure by taking away the interest rate from those US government bonds, away from the interest rate from US government bonds which are inflation linked. Just a quick side note, there are two main types of US government bond, nominal and inflation linked. The main difference is that with the inflation linked government bond, which are called TIPS, the interest payment that the government has to make to their lender increases with inflation. Anyway, this break-even inflation highlights the anticipated inflation rate in the economy over time. And that is the number which has been creeping over 2% already. And this, my friend, has well spooked the stock market, because higher inflation means the Fed is expected to increase interest rates soon. Now the question is, why is high interest rate making the stock market go all crazy? I mean, it clearly makes sense that the interest rate was cut last year in order to fight COVID, and now that we're coming out of COVID, it only makes sense for the rate to go up, at least to the pre-COVID level. Well, to understand this, think about how we calculate the true intrinsic value of stocks. We financial analysts use different types of models to come up with true price of a company stock. One such model is called the discounted cash flow model. This model predicts the future earnings of a company or a stock and then discounts them back using the interest rates to make them comparable to present time. So think about this. When interest rates increases, it reduces the overall true intrinsic value of these stocks. And so when you compare this model's true intrinsic value to the current market price of the company stock, more likely than not, it will tell you that the current stock price is overvalued. This is exactly why a lot of these stocks have been selling off, especially the growth stocks or those that had a terrific run right after COVID-19 sell-off. Some of these stock prices were up well over 1000% just over 9 months, which is pretty strange and exactly why even a little bit of increase in expected level of interest rates are making them look all extremely overvalued. You can check out my previous video on differences between value versus growth stock to really understand why the growth stocks are taking a much bigger hit. So this was the interest rate argument. The second argument behind the stock market sell-off is actually the inflation itself. Traditionally, stocks are poor hedge for inflation because high inflation eats away the true value of future earnings. And not all companies are able to pass on higher inflation or prices directly to their customers. This is why, again, a lot of companies where demand for their product is extremely sensitive to price are selling off the most. Now that you're familiar with the economic rationale, should you be worrying about what's going on? Firstly, I will say there is no reason to panic about when it comes to inflation. Because the Fed is not like the way it used to be a few years back. They even changed the way they look at inflation last year. Before, the Fed was strict on the 2% inflation mark, but now they introduced what is called an average inflation targeting. This means the Fed will be okay for inflation to go above or below 2% for quite a while, as long as the average inflation rate number is 2% over some period. The Fed have been openly saying that the country is long way away from the inflation and the total employment target. Secondly, if at some point soon the Fed starts to increase the interest rate, they will only do so because the actual economy is improving. Improving economy is good for the stock market, and we are currently already at a rate which is very close to zero. So it is very unlikely for the rates to increase drastically from this point onward. And my third point is that if you already have a well-diversified portfolio, there is absolutely no reason for you to worry about anything that's been going on in the market right now. The reason why we have heard so much news and hypes, especially from the retail investors, is because a lot of us retail investors, our portfolio is concentrated with high growth tech stocks, a lot of which are in fact loss-making. They were already at an extremely high valuation point, which is why they have sold off the most. So if you have most of your investments in an index fund, which generally tracks the overall economy, then there is nothing for you to panic about. This is not an investment advice, just some food for thought. Basically, diversify your investment, have some dollar cost average in your portfolio, and over time you should be okay. That's all for today. I hope you found this video useful. Until next time, look after yourself and your money.